Joining me on stage today, two of our best, I would say, in the research team. We've got Madhur Jha, our head of thematic research at Standard Chartered, and Philippe Dauber-Paternace, senior economist and global geopolitical strategist at Standard Chartered. We've got only 20 minutes set aside for this session, so let's get right into it. Philippe, if I may start with you. Lots going on in the world. I see geopolitical tensions pretty much dampening economic optimism. I see a lot of competing blocks emerging. What do you see?
Well, I think that the way you can make sense of a world that is being really reshaped can be approached, I would say, through two different, very simple analytical frameworks. The first is really to try to wonder, how is the world competing? And the clear answer to that, is obvious, is that increasingly we are seeing two main blocks emerging. On one hand, you have the US and its allies, and on the other hand, you have the obvious, sort of axis of alignment between Russia and China. And just one quick note on this, because I get that question a lot from clients. I think that the alignments between Russia and China mostly find a common purpose in their willingness to challenge a world order that they perceived as having been designed by and for Western interest. And so they need each other to actually, challenge that world order. And I think the third point to make on this, that is probably often lost in the conversation, is that these two blocks are competing to exert influence on a third block, which essentially is the rest of the world. And that's the vast majority of emerging markets. And the second analytical framework we can suggest in this competition at the global level, which is sort of a follow-up of the first one, is that in this competition at the aggregate level, on average, the West is not doing great. And part of this is linked to the conflicts that keeps popping up everywhere, and these conflicts are fast worsening the competition of worldviews. This was true when the war in Ukraine started. Remember when the West demanded that the rest of the world, but mostly emerging market, condemn Russia's invasion on Ukraine as a moral imperative. But it became even more salient after the start of the conflict in the Middle East, which is deepening fault lines of an already very fragmented world. And in very simple terms, I think that the perception in most of the emerging market world is that the West has been supporting Israel for way too long, while Russia and China have appeared much closer to the Palestinian claims. And in this, the global South accuses the West of double standards and what we call selective empathy. And to finish on that, I think that what's interesting is that even if the US and Europe, probably mostly Europe, have changed, nuanced their approach to the conflict in the Middle East, they probably already have lost the battles of narratives, in the global South at least, and a sense of moral leadership, which tended to be actually one of their strongest arguments that they projected to combat alternative value systems.
So, in very, very accurate and interesting picture, when I look at the world, I feel that countries are really increasingly picking their trading partners, of course, based on economic interest, but also based on their national security concerns. So how do you see that impacting global trade, the globalization as we know it today?
Thank you for that, Lisa. I think this is the heart, actually, of geoeconomics today. Trade is massively driven by essentially the way supply chains are set up. And in fact, globalization has really thrived on the back of the global allocation of these supply chain, and production line, basically following the traditional economic theory of the international division of labor. But increasingly in recent years, politics have infused even the concept of supply chain. And geopolitics now sort of forces to make trade-offs between efficiency and security. And we have all heard about, the concept of, reshoring, nearshoring, even friendshoring from Janet Yellen. And this might be just words, but they actually convey very well what is happening. And it's the fact that most corporates and sovereigns are reassessing their exposure to the supply chain risk. And they're literally mapping out where they have exposure geographically and at what point of their supply chain. And inevitably, this leads to two main consequences. You could say that the first is we are witnessing a slowing of global trade, which has historically been the main driver of globalization. And this is why some have started to talk about slowbalization. So it's this idea that globalization continues, but at a slower pace and takes different forms. And the second is a change of trade patterns. And so typically and quite symbolically, in 2023, Mexico became, again, the first trading partner of the US after decades, surpassing China. But to finish on that point, I think that the key here is that, first, we should not see all of that solely under the angle of threat. It also presents a lot of opportunities for corporates, but also, countries. There are many countries in Asia, for example, in our footprint, that are benefiting from what we call the China Plus One strategy, where basically you try to build new capacities outside of China as an edge. We all heard about Vietnam, Bangladesh, and of course India. And beyond Asia, there's obviously Mexico that we just mentioned. The second point is to say that fragmentation is useful to understand the world, but it's probably a partial concept only. And when I say a partial concept, we prefer to describe selective fragmentation. What does it mean, selective fragmentation? It's essentially the idea that, yes, Europe is putting huge tariff on electric vehicle coming from China. The US is doing the same. You have increasing frictions on multiple parts of global commerce with China. But don't conflate that with the big picture. The big picture is that China is still the factory of the world, and this is not changing anytime soon. And beyond certain very precise, products, we're still going to buy from China, and China will still going to continue to commerce with the rest of the world.
Moving gears now a little bit and talking about interest rates and inflation, Madhu, I'd like to bring you in on the conversation. Until the advent of the euro, really, global interest rates have very much moved in tandem, right? We've recently, though, witnessed something very different. Canada became the first country last week only to cut interest rates, followed one day later by the ECB. I was just reading in the FT this morning, it doesn't look like the Fed will be doing many rates this year, maybe only one. So why are we seeing this decoupling of monetary policies?
Okay, thanks so much, Lisa. So I think maybe calling it decoupling is maybe an exaggeration. There's definitely a divergence that's coming through, and that really reflects, as it should, the divergence in the growth and inflation profile of different countries. So if you remember at the start of this year, it doesn't feel like that, but just at the start of this year, markets had priced in 175 basis points of rate cuts from the Fed, right? 5 months down the line, we are getting questions from clients whether there'll be rate hikes, right? And that reflects the strength of the US economy. Labor markets are extremely strong. Inflation has been higher than what was expected. And that exceptionalism or resilience of the labor markets and the US economy is reflected now in rate expectations. For the ECB and for some of the other countries, and the issue has been that the economy has been weaker in the euro area, partly because, of course, you had the impact from the war, Russia-Ukraine war, and also the energy cost rises were very, impactful and had a very negative impact. But I think, again, as I said, to call it decoupling is going to be excessive, because we are already seeing not just us, but also people in the market start to revise their expectations of how central banks move if the Fed doesn't move, right? So we have had to pare back our expectations of rate cuts from the Bank of England, from the ECB. Of course, China is in its own, disinflation, weak economy story, so they're having their own thing. But even emerging market, central banks, if you look at it in Asia, if you look at Malaysia, Indonesia, if you look at Philippines, they're all talking about the risk of currency weakness, and so they don't want to move too much in divergence with the Fed. So if the Fed has a smaller number of rate cuts and a shallower rate cutting profile, you are most probably likely to see other central banks also adopting a more cautious approach, because we have to remember that a lot of the global drivers of inflation will impact everybody, right? And so central banks will be watching that.
That's a perfect segue, because I was going to talk about, of course, inflation. You have to talk when you talk interest rates. And it strikes me, of course, the drivers have been very different, right? In Europe, you mentioned it's been primarily driven by energy prices. In the US, very different story. The economy has been quite strong. Demand has been strong. That has pushed prices up. So what do you think will happen to inflation? What could happen in the short and medium term? What is it going to continue creeping up? What's your take?
So obviously, our expectation very much is that there will be a disinflation process that will still be in play, and that's why we are still expecting rate cuts from central banks, right? But I think it's very important to kind of maybe look at the details of the inflation story. What we have seen is that because of the war, because of COVID, we saw a very sharp rise in goods inflation and energy prices, and then that kind of fell off last year. So goods disinflation has been in play for the last year. It's services and core inflation, which is very strong and sticky and above central bank targets. And that's really a reflection, again, as I said, of labor market strength. Even in the euro area, you have historical low unemployment rate at this point of time. So labor markets are fairly strong. Central banks are watching what's going on the wages side. So we need to see labor markets start to ease off a bit, or wages becoming a little bit softer for central banks to be very confident. And we are beginning to see some of those numbers coming through, and that is a process that we expect going forward. What the risk is over the next few months, and this is something we are flagging to our clients as something that they should track, is that the goods disinflation story, which was baked into the numbers, is now beginning to look like it might reverse. So a couple of points to note here. Of course, we seem to be in a manufacturing upcycle at this point of time globally, led by semiconductors and AI-related equipment, but there is more demand for goods coming back. So that really arrests your goods disinflation story. The second thing is, we are beginning to see, you were talking to Philippe about the trade wars, right? We are beginning to see the impact of these trade wars already. So shipping costs have recently jumped up again. They jumped up first because of the Middle East crisis, came back down. Then they've jumped up again recently. And we've done some research to see what's going on. And we found that this is partly a reflection of a lot of containers from China being front-loaded with electrical vehicles, etc., and being sent to destinations either in Latin America or in Europe to try and avoid this imposition of tariffs that is likely to come through, in the next few months. So shipping costs are going up. We are watching that carefully. And food inflation is something that we are tracking. We had El Nino conditions last year. El Nino usually leads to a rise in food inflation with a 6-month lag. We are beginning to see food inflation start to pick up. Again, this will add to the reversal of the goods disinflation story. So shipping costs, food inflation picking up is something we are tracking. And on top of all of that, we're also obviously going to be tracking energy, because the conflict could always mean a higher energy price. For emerging market central banks, this is a big issue, because they have very big weights of food and energy in their baskets. So yes, disinflation will continue, but the risks are rising that the story might be a lot harder to achieve than before.
I was listening to an FT podcast last week. I'm a big fan of. It's called Unhedged. And I really liked the opening lines. I'm going to steal it for this next introduction to a theme. And it said the big risk for 2024 is this annoying thing called democracy. And I thought, what a better way to really talk about elections. We will be having, I think, something close to 1.5 billion people hitting the polls this year. We will have around 50 countries voting. We've just had a female president elected in Mexico. India just had its elections. Of course, France is going to have parliamentary elections now towards the end of the month, beginning of July. And of course, we've got the US elections coming up. So what is all of this doing to markets?
Yeah, so, it's a little bit contentious to talk about election in France these days, let's put it that way. But you're right, I mean, we started the year, published a paper, I remember, people were surprised, but 2024 is the largest, the largest number of elections in modern history, and in terms of the numbers of people who are going to go vote, and as we keep saying, I mean, we shouldn't detract our attention from it, because a lot of them are market moving, and in interesting ways, because if you look at the last elections in major emerging markets, we were discussing that yesterday in client meetings. On one hand, you have the market that has been punishing Mexico because the government, the ruling coalition, got too big of a mandate. They managed to get too big of a result. And in India, the market, at some point punished, India, because actually Modi didn't get enough, it's just, and that's the way it works. But as you point out, I mean, and let's not forget there's going to be a lot of major election coming up. The biggest one that everyone wants to talk about is the US election. It's still, the mammoth, the mother of all the elections in terms of global geopolitics. And on this, I'm going to be very quick. If we laser focus on just one topic, it's trade. And we actually co-wrote a paper with Madhu on that a few months back. And what we say, so the way we work is that we try to look, we take the politics out of it, to really try to look objectively, the program of both candidates and which one could be market disruptive. And what we found is that clearly, if Trump is elected and if, there is an if here, he executes on his program, we're going to witness the largest revival of trade wars that could lead the world to, a global trade war. We haven't witnessed, since the 1930s. He's talking about imposing a 10% tariff on all US imports, 100%. We're not talking about China. We're talking about, goods from Europe, from India, from Africa, from everywhere. And he's been talking also about putting 60% tariff on all Chinese imports, and that's still the largest, actually, trading relationship. And the fear is that obviously this would get to a tit-for-tat, war reaction. We know that the EU has spent the last 4 years preparing for that eventuality and developing legal toolkits to actually respond very quickly if that were to happen. So that is really our biggest concern in terms of market disruption if the scenario unfolds.
Madhu, just very quickly, is it fair to say that all these electoral cycles are influencing monetary policy?
No, not yet. I think the Fed has been very clear that it's looking at the growth and inflation numbers, and you can see that they've taken a more hawkish stance as of yesterday as well, and that brings them dangerously close to the actual election date before they might move. But we have written a report, and we have been flagging something that now I think is getting increasing airtime and discussion within even central banks and academics, is the concept of fiscal dominance. Fiscal dominance is when fiscal policies drive growth and inflation objectives rather than monetary policy. As we are seeing right now, we are seeing mostly monetary policy driving or being used to achieve growth and inflation targets. Fiscal dominance happens when you're basically monetizing central bank deficits. And the real risk is if either party has, in the US in particular, is showing very little fiscal restraint. There is no real fiscal consolidation plan in the US. And that means that their deficits stay above 5% of GDP for the next decade and could actually even explode beyond that. If you have geopolitical tensions, if you have trade wars, who buys that increasing supply of bonds that's coming? And if the US could have a scenario where the central bank or the Fed is forced in a way to buy more of US debt, then how does that impact other central banks and what do they do? So I think this is a discussion which we will see a lot more of. It's not a key issue right now, but I think becomes more of an issue after the elections. But to answer your question, no, not at this point, but keeping our eyes peeled to see what happens once the elections are over and if they give us any fiscal consolidation plans.
Sadly, we have to leave it here. A big thank you to our research team. Please don't go anywhere.